Investors typically think of diversification in terms of industry or geography, but a further element of diversification they should think of in terms of their stock portfolio is their exposure to economically sensitive versus less economically sensitive sectors. The stock market is split up into 10 sectors, 10 global industry classification standards. 7 of those 10 sectors are quite economically sensitive, but 3 of them, healthcare, utilities, and consumer staples, are much less vulnerable to sudden changes in the business cycle. While these 3 industries are obviously tremendously different, there is a common denominator in that there is typically a high degree of predictability around revenues and costs, and thus correspondingly a fair degree of visibility in terms of earnings and free cash flow generation. A further coincidental characteristic of these sectors is they tend to have a strong number of stocks with strong cash return policies, by which I mean they pay a lot of dividends and they have share buyback plans. Both dividends and share buybacks are equally important components of a company's cash return policy. Dividends are critical because they pay you to wait should the stock market go into a prolonged slump. Furthermore, growth in dividends is the most tangible proof available of genuine wealth creation via stock market investing. By this I mean, imagine a stock that you purchase with a 2% dividend yield, but which is growing that dividend by, say, 10% per annum. That dividend is going to double in 7 years and double again in 14 years. Share buybacks are important because they provide ongoing support for the shares. They offset the dilution by a stock option plan that the company may have. And most importantly, they send a pretty clear signal from the CFO and the board of directors that they believe the shares are attractively valued and an attractive investment. Diageo is a defensive stock with a great cash return track record. It is the largest spirits firm in the world. Its brands include Smirnoff, Tanqueray, Johnnie Walker, Bailey's. It owns a third of Veuve Clicquot and Dom Perignon champagnes and is the brewer of Guinness Stout. It's a stock that we had long admired, but we thought the shares were fully valued until recently, when the weakness in the markets in early 2008 provided us with an entry point to purchase the shares on behalf of our clients at a much more agreeable price. Diageo's defensive characteristics stem from 2 main sources. First, spirit volumes globally typically remain positive even during severe economic slowdowns. People still need a drink if the economy is going through a rough patch. Secondly, spirits as a business are very different than lager. When you think of spirits, there are really only 2 or 3 key brands in each category. This is a much different situation than a lager, where there are literally dozens of brands that have a global presence. Correspondingly, in spirits, it's much easier to defend and build market share than it is in lager, for instance, where it is a perpetual and perennial fight simply to keep the market share you have. In conclusion, a stock's defensive qualities are a function both of the line of business it's in, as well as its financial strength and its financial policies in terms of shareholder remuneration. Toron pays close attention to the mix of economically sensitive versus less economically sensitive stocks within a client's equity portfolio. Finally, investors would do well to maintain a rainy day wish list that they can capitalize upon should markets sell off steeply and suddenly.